So the LLC is one of the most flexible business entity structures you can have because you can actually choose how you want it to be taxed. And probably one of the most popular things to do with your LLC is elect it to be taxed as an S corporation. And this is something that many accountants and attorneys recommend, but listen, there are some major, and I mean major disadvantages of S corporations that many people don't talk about. And sometimes I find myself having to tell new entrepreneurs,
oh, don't do it, please don't do it.
Because even though S corporations are very popular, it doesn't mean that you should rush to become one. So in this video, what I want to do is cover the differences between a default LLC and an S Corp, the major disadvantages of an S corporation, and why you should wait to elect to become one. And so if you watch this entire video until the end, then I'm very confident that you're going to learn how to avoid some costly mistakes and save yourself thousands of dollars in taxes. So if all that sounds good to you, then all I ever ask is for you to hit that like button for the YouTube algorithm. That way other people like you can find this video and learn about the S Corp disadvantages, and also subscribe for more videos like this. Stay tuned. Hey there, and if you're new, welcome to our channel. I'm Sean with Life Accounting, the accounting company that helps you save on taxes and build more wealth. And as always, what I'm gonna do is put the timestamps for this video somewhere down in the description below so that you can skip to the parts that you want to learn the most about. But look, this is definitely gonna be one of those videos that you wanna watch entirely and maybe even multiple times. All right, let's go ahead and get this party started with number one. What is an S corporation, also known as an S Corp? So technically, an S corporation is not a business entity that you set up or register with your Secretary of State, but rather it is a tax election. And so you can elect to have your LLC or your corporation be taxed as an S Corp, usually through filing IRS Form 2553. Now, with all this, I assume that you already know what an LLC or limited liability company is, but if you don't, then in one sentence, I would say that an LLC is a very popular business entity because it separates your personal assets from your business assets, which of course can then protect your business from affecting you personally. Now, if you'd like to learn more about LLCs, the advantages, the disadvantages, then what I'll do is I'll link a video at the end of this one so you can watch it right after you finish this video. But anyway, since S Corps are often tied to an LLC or a corporation, they also have limited liability protection, which again protects your personal assets from your business liabilities. So that is not on my list of disadvantages. But before we dive deeper into my list, let's get back to the original question of what is an S corporation? Okay, so here's how the IRS defines it. S corporations are corporations or other entities that are eligible to be treated as a corporation that can elect to pass corporate income, losses, deductions, and credits through to the shareholders for federal tax purposes. Now, I know after reading that, the average entrepreneur is probably like, okay, that makes sense, but what exactly does that mean? Okay, so let's break this down a little bit more. So when you're looking at different entities or tax structures, there are generally two types. You either have a pass-through entity or you have a taxed entity. So when you make business income with a pass-through entity like a sole proprietorship or a general partnership or even a default LLC, then what happens is your business income passes through your entity and goes straight down to you as an individual. On the other hand, when you have business income in a taxed entity like a C corporation, then the income is taxed at that entity level or at that corporate tax rate. And if the shareholders or owners want to take income, then they would need to take a distribution as dividends and pay taxes on that dividend income, which also describes double taxation because you pay taxes once at the entity level and then again at the personal individual level, which can easily make your tax rate more than 40%. Okay, all that was important to note because people often confuse S corporations with C corporations, but I need you to understand that S corporations are treated as pass-through entities, whereas C corporations are taxed entities. Okay, so the IRS is basically saying that any profits and losses from a S Corp will flow down to the individual and will be subject to individual tax rates. Now, if all of this is still a little bit confusing, then you can consider working with us one-on-one through our tax services and programs. If you're interested in learning more, then just click the first link down in the description below. Cool. Now let's move on to number 2 and talk about some of the advantages of an S corporation. Now, before I get into the disadvantages and why you should hold off on becoming an S corporation, I want you to be aware of and know that I'm aware of some of the major advantages of an S corporation. Okay, so number 1, you can avoid double taxation because, again, S Corps are pass-through entities. Now, while this may be an advantage for many new businesses and entrepreneurs, there are definitely times when it makes a lot of sense to become a C corporation for tax purposes, even in the face of double taxation. And I have an entire video where I break down the benefits of a C corporation, which I'll link down in the description below. The second advantage is number 2, legal separation and asset protection. Since S Corps are legally separate from its owners, only corporate assets, not the owner's personal assets, face exposure in the event of a lawsuit or some other liability situation. This separation also gives another advantage, which is what I would call advantage 2.5, which is the ability to build business credit faster. Okay, the third advantage and probably the most popular advantage of an S corporation is number 3, reduced self-employment taxes. Since the IRS views S Corp owners as employees, they only need to pay self-employment taxes on the salary that they receive from their corporation. But they do not need to pay self-employment taxes of 15.3% on dividends and distributions they receive as shareholders, which can dramatically reduce their tax bill. For example, if you made $200,000 in business profits and you gave yourself a reasonable salary of $100,000, then hypothetically you could have $100,000 in dividend distributions that aren't subject to self-employment taxes. And that could easily save you $15,300 in taxes, which is $100,000 profit times 15.3%, which is why so many people love the idea of becoming S corporations. But these tax savings don't happen for everyone, and we'll talk about why going into number 3, the disadvantages of an S corporation. All right, now you should have enough context to be on the same page with me when I say I don't think you should form an S corporation, starting with the biggest reason: you must take a reasonable salary. Yes, the IRS forces S corporations to pay a reasonable salary to all employee shareholders or owners who are actively working in the corporation. And a reasonable salary is considered to be compensation that you will pay someone else to do the exact same job that you are doing. And the thing that gets many business owners in trouble is that they are usually juggling multiple things and working many hours a week, right? You may be doing sales and marketing and recruiting and operations and servicing clients and customer service, billing, and a lot more. And you may only pay yourself a reasonable salary based on maybe some entry-level sales tasks that you do. But someone who is in a role where they're juggling a lot of stuff may be more comparable to something like a general manager or operations manager's salary. And this makes a reasonable salary problematic for 3 big reasons, starting with number 1, your income can be reclassified as wages. Okay, this is likely to happen when you have a one-person company and you're doing all of the work. And to highlight this, let's look at a tax court case, a real tax court case called Glass Block Unlimited versus Commissioner of Internal Revenue. So a man named Frederick Boglet was the president and sole shareholder of his S corporation, where he sold and distributed glass blocks. Now, the S Corp had no full-time employees, and Mr. Boglet was responsible for all the operations of the corporation, aka he was a one-man show. Now, during the tax year, he did not pay himself a reasonable salary and received distributions of $31,644 that were not subject to self-employment taxes. However, the IRS spotted this, and the court found that any officer who performs more than minor services for a corporation and receives compensation in any form is considered to be an employee, and his or her wages are subject to employer payments of federal employment taxes. In other words, the court found that under his S Corp, the $31,000 distribution was instead a $31,000 salary because he was the sole employee responsible for all the business operations. So he had to go back and pay self-employment taxes on that full $31,000. Now, there are other tax court cases where shareholders did not pay themselves enough salary and the IRS determined a reasonable compensation for them. Which, by the way, if you want to see me review more IRS court cases in my videos, then please tell me in the comment section below, because I definitely don't want to keep referencing these court cases if you don't find them to be helpful. Okay, the second problem with a reasonable salary is number 2, a reasonable salary can stifle business growth. Because listen, with an S Corp, you should be paying yourself regardless of how much profit you make. Okay, even if you are making a small profit where you can't afford to put yourself on a reasonable salary yet, it is still recommended that you use the 60-40 rule, where you pay at least 60% of your profits as a salary and the other 40% as a distribution. So hypothetically, if you made $50,000 in business profits, then with the 60-40 rule, you would pay yourself a reasonable salary of $30,000, which leaves you with only $20,000 to reinvest back into your business. So if you want to grow aggressively and you're willing to reinvest, or heck, even if you just want to make sure that you maintain a healthy cash flow, then putting yourself on a reasonable salary can obviously stifle your growth and could compromise that a lot. So that's big. Okay, the third problem is that you don't have enough income to justify an S Corp reasonable salary. Because to put yourself on a reasonable salary, your S Corp needs to, cover half of your payroll taxes. They must send you as an employee a W-2 form. The S Corp will also need to pay unemployment taxes, and your company may have to provide workers' compensation coverage depending on the state that you live in. Your company may also have to pay state disability insurance as well. And look, all of these things take time, they take money, and they take research to successfully set up. So going back to my last example, if you are making $50,000 in profit and you pay yourself a $30,000 reasonable salary and you had distributions of $20,000, then maybe you could save about $3,000 in taxes, but then you have to ask yourself, is it really worth it? Because now you're going to have to spend more time setting things up. You may also have to hire a professional, and you're going to have to file a separate tax return for tax purposes. Many tax preparers will charge you $2,000 to file an S Corp tax return, which wipes out more than half your savings already. Now, of course, when you start making more than $50,000 in business profits, then the tax savings can start to outweigh the cost and the time that it takes to elect to become an S corporation, especially if you are not doing a lot of reinvesting. But look, there are still some more disadvantages of an S Corp that you want to be aware of, starting with number 4, more IRS scrutiny and rules to follow. The IRS tends to look at S corporations a little bit more carefully because they know many business owners will elect to become an S Corp since it can reduce their self-employment taxes. And heck, I personally think that they may even set up systems one day to automatically check the salary to distribution ratios to trigger an IRS alert. On top of the extra scrutiny, S corporations must follow additional rules that don't apply to a default LLC and sole proprietorships. For example, S corporations must have a board of directors and hold formal management meetings like annual shareholder meetings. They must issue stocks and shares to the owners instead of a flat ownership percentage. And like we talked about in depth, they must also take a reasonable salary as an owner employee. And there are other regulations to follow around dividends, around tax filing requirements, recording meeting minutes, and so on. And so if the company fails to follow any of these rules, then it can lose the S corporation status and be reverted back into a default LLC, which means any income would pass through to the actual owners and be subject to self-employment taxes. So of course, you don't want to go through all the hassle of starting your S Corp and losing the status. So following the rules are super important. Another disadvantage to consider is comparing an S Corp to a C Corp, which is number 5, less ability to raise capital. Because when it comes to raising capital, S Corps can only have one class of stock and have no more than 100 shareholders. So this basically decreases the ability for an S Corp to raise funding and find investors compared to C corporations who have unlimited classes of stock and unlimited amount of shareholders. Also, S Corps can only have shareholders who are US citizens or at least US residents, which further limits their ability to raise money for business growth. Now, I should mention that S corporations still have a slighter edge on raising capital than a default LLC, but barely. Okay, let's bring this all together and talk about the fourth part of this video. Number 4, when should you become an S corporation? Well, as it is with most things when it comes to taxes and business, it depends on your financial numbers and your long-term business goals. And the two variables that you're going to want to play with are, okay, how much profit do you anticipate having? And then number 2, what are your goals with that profit? For example, if you are making over $50,000 and you are not aggressively reinvesting profits, then maybe you can consider becoming an S corporation. On the other hand, if you are making more than $50,000 in business profits and you plan to aggressively reinvest those profits for more business growth, then maybe you can consider a default LLC or a C corporation. Or maybe you're making less than $50,000 and you're not sure if it's worth your time to make the switch, then you could consider a default LLC or even a C Corp. But overall, deciding to become an S corporation or really any business entity has many different pros and cons. So it's really up to you to carefully map out what it is you want to accomplish for your business, thinking about both the short-term and long-term potential outcomes, which is why I created a video on how to choose the best business entity for you coming up next. Or you can check out another video that I mentioned I will link at the end, and I'll see you over there.